$8. Not a fortune, not a headline number that would ordinarily summon urgency, yet in the quiet, disciplined world of global commodities, where margins are measured in basis points and fortunes are made in fractions, that $8 premium has become something far more consequential, a signal. A signal that something in the global financial architecture is no longer behaving as it should. At this moment, industrial buyers in Asia are paying approximately $8 per ounce above Western benchmark prices simply to secure physical silver. Not paper claims, not futures contracts, not the elegant abstractions traded in climate-controlled exchanges, but metal, dense, tangible, and unambiguous. Metal that can be held, stored, and counted. This premium has not flickered in and out of existence like a speculative anomaly. It has persisted, day after day, week after week, long enough now to force an uncomfortable question into the open. What happens when the East begins to price reality differently than the West? Because that, in essence, is what this is. A divergence not merely in price, but in belief. The Western system, anchored in exchanges, derivatives, and financial engineering, continues to value silver through a lens of liquidity and leverage. The Eastern system, increasingly, appears to be valuing it through a lens of scarcity and possession. And history, when consulted honestly, tends to favor the latter. What makes this moment particularly arresting is not simply the premium itself, but the duration. Markets tolerate brief inefficiencies. They correct them swiftly. Arbitrageurs, those tireless custodians of equilibrium, typically erase such discrepancies with mathematical precision. Yet here, the discrepancy remains. Why? Because the usual mechanism, buy low in one market, sell high in another, is no longer functioning with its customary ease. Barriers, both logistical and regulatory, have begun to interfere. Capital, which once moved freely in pursuit of efficiency, now encounters friction. And friction, in markets, is often the first sign of structural change. Consider then what it means when participants are willing to incur billions in additional cost merely to secure physical supply. It suggests not speculation, but preference, not opportunism, but conviction. And conviction, when widely shared, has a way of rewriting prices. Now layer onto this the second observation, one less visible but perhaps more revealing. The great vaults of London, long regarded as the epicenter of global silver clearing, have been quietly, steadily declining in their holdings. Not collapsing in dramatic fashion, but diminishing with a persistence that invites scrutiny. Over recent years, thousands of metric tons have exited these vaults. The metal has not vanished, it has migrated, eastward predominantly, toward Shanghai, toward Mumbai, toward jurisdictions where possession is increasingly prioritized over exposure. This is not the behavior of a market in equilibrium. It is the behavior of a system redistributing its foundations. And here is where the story becomes less about silver and more about something larger: trust. For decades, the Western pricing mechanism has relied on a simple premise, that paper claims are sufficient proxies for physical assets, that a contract, backed by institutional credibility, is as good as the thing itself. But what happens when participants begin to question that premise? What happens when ownership becomes preferable to representation? The answer, if history is any guide, is that the price of the underlying asset begins to reflect not just its utility, but its certainty. And certainty, in uncertain times, commands a premium. Stay with this thought, because what follows is where the narrative sharpens. India, a nation whose relationship with precious metals is both cultural and economic, has dramatically increased its appetite for silver. Not modestly, not incrementally, but at a scale that commands attention. Imports have surged to levels that absorb a meaningful portion of global supply, and importantly, this demand is not purely decorative. It is not driven solely by jewelry consumption or seasonal buying patterns. It is structural. Industrial expansion, particularly in solar energy, has created a persistent demand base. At the same time, investment flows into silver-backed instruments within the country have immobilized large quantities of metal. Silver, once circulating fluidly through markets, is increasingly being held. And held metal does not return easily. This distinction matters, because markets can accommodate high demand if supply remains elastic. But when demand is paired with immobilization, when the metal is not merely purchased but removed from circulation, the dynamics shift. Supply tightens, prices respond, and the gap between perception and reality begins to widen. Now, if you are still here, still following the thread, then you are already ahead of most. Because what we are discussing is not the headline narrative you will encounter in passing. It requires patience. It rewards attention. And if this kind of clarity matters to you, if you prefer signals over noise, then take a moment to subscribe, not out of habit, but out of intention. Because the next part of this story will move quickly, and you will want to see it before it becomes obvious to everyone else. Because the third development, perhaps the most consequential of all, has already begun. China, methodical, deliberate, and rarely impulsive in matters of strategic importance, has introduced new controls over the export of refined silver. What was once a commercial channel has, in effect, become a regulated pathway. This is not merely bureaucratic adjustment, it is policy. And policy, when applied to commodities, reshapes flows. By restricting outbound silver, China has accomplished something subtle yet profound. It has localized supply. It has made domestic silver more valuable relative to international benchmarks, and in doing so, it has reinforced the premium that first caught our attention. Markets, deprived of arbitrage, begin to fragment. Fragmented markets do not converge easily, they diverge, and divergence, sustained over time, becomes repricing. The implication here is not speculative, it is structural. When the largest manufacturing base in the world begins to prioritize retention of a critical input, the global balance shifts. Add to this the behavior of lease rates in London, the quiet heartbeat of the metals market, and the picture becomes even more compelling. Lease rates, which historically hover near negligible levels, have risen to multiples of their norm. This is not a trivial detail. Elevated lease rates indicate reluctance to lend, and reluctance to lend indicates perceived scarcity. In other words, those who possess the metal are increasingly unwilling to part with it, even temporarily. That is not the posture of a market flush with supply. It is the posture of a market reassessing value. And then there is the ratio, the ancient, enduring relationship between gold and silver. For centuries, this ratio has oscillated within a relatively stable band, reflecting the interplay of monetary and industrial demand. Recently, however, that ratio has compressed significantly. Silver has begun to outperform gold, not in speculative bursts, but in sustained movement. This is not typical. Gold, the archetypal monetary asset, does not easily cede leadership. When it does, it suggests that silver is being reevaluated, not merely as an industrial input, but as a monetary instrument in its own right. This is where the narrative once again expands. Because if silver is indeed being repriced as a monetary asset, then its valuation framework changes entirely. It is no longer tethered solely to industrial demand or economic cycles. It becomes part of a broader conversation about currency, reserves, and global financial alignment. And that conversation is already underway. In emerging markets, particularly among nations seeking diversification away from traditional reserve structures, there is growing interest in alternative stores of value. Gold has led this movement. But gold, by virtue of its density and cost, is not always practical for large-scale transactional use. Silver, by contrast, offers accessibility. It is divisible. It is abundant enough to be usable, yet scarce enough to be valuable. And in a world exploring new frameworks for trade and settlement, those characteristics matter. So the question is no longer whether silver is moving, the question is why. And more importantly, whether the current price, still anchored in Western paper markets, fully reflects the realities emerging elsewhere. Because if it does not, then what we are witnessing is not a rally, it is a transition from one pricing paradigm to another. And transitions, in markets as in history, rarely announce themselves politely. They unfold gradually, then suddenly. They reward those who observe early and penalize those who react late. So here's the thought I want to leave you with before we move to the next part. If the price you see on the screen is determined by one system, and the demand you observe is driven by another, which one do you trust? Because the answer to that question will determine not just how you view silver, but how you interpret the broader financial landscape unfolding around it. We will follow that landscape further into central banks, geopolitical alignments, and the quiet but unmistakable signals of a system under revision. But before you go, I want to hear from you. One word, just one. What is the single data point in this story that surprised you the most? Drop it in the comments. Because that conversation, your perspective, your insight, is where the real understanding begins. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in mind.